Good morning. The hidden cost of hard money and what it really does to your returns. Well, hard money loans are marketed as fast, flexible, and investor friendly. And sometimes they are. But what most borrowers fail to calculate is really the true cost of the hard money financing beyond just the rate and the points. And as a mortgage broker and commercial lender at Medallion Funds, I've structured everything from bridge loans to DSCR financing and long term commercial takeouts. And here's something I can tell you pretty confidently: speed is definitely valuable and it always will be, but structure is what determines your profit. So let's break down what hard money really costs you in this next segment. So let's start here. What is a hard money loan? Well, a hard money loan is a short term asset based loan that's typically used by, for instance, fix and flip investors, Burr investors, or developers needing quick closings to reposition assets. And borrowers with credit or income challenges could be another category. What these loans do is they're usually going to feature, say, somewhere in the ballpark of 8 to 14% interest rates with 1 to 4 points up front. And generally, you only have a 6 to an 18-month term on these, but they will offer interest only payments. Generally, there's not prepayment penalties or minimum interest requirements unless you get to a bridge situation where there's usually an exit fee, which is another way to say prepayment penalty. And on paper, it sounds manageable, but here's where the hidden costs begin. So the first point is points and origination fees will compound fast. So let's take an example here. Say we're getting a $500,000 loan, and 3 points from that would be 15,000. And then you have a 12% interest rate on your note, so that's 60,000 annually. Now, before renovation costs or holding expenses, you're already carrying 75,000 in financing costs in the first year. And what that does is it dramatically compresses profit margins, but it does also provide the opportunity to continue to make those at better terms when you refinance. Two, there's time risk, and that means rate risk. And hard money assumes quick execution. Where it stings is when delays happens. So think permit slowdowns or contract overruns, or if you have appraisal issues when you're trying to market the property or develop it. But also if the market shifts. And every extra month, the 12% interest is going to erode your returns, and make sure you build in that purchase price properly is another point. Now, in Houston and West Texas markets, I've seen projects profitable on paper become break evens simply due to timeline extensions. So keep it in mind. Three, the refinance risk. And here's the biggest hidden cost. Most hard money strategies depend on a refinance as an exit. And if your DSCR ratios tighten, or if rates rise, or if your appraised value becomes in a little bit lower than what you projected, or if your rental income doesn't support the new leverage that you need to make the exit work, you could be forced to inject additional capital, or just to accept lower leverage, or you could be forced to extend your hard money loan at higher rates. And sometimes that results in the decision to sell prematurely. And the point is, this is where investors can lose control. So let's try to avoid it. Number four is your opportunity costs. So high interest carry is going to impact your cash flow. It's also going to eat into your liquidity because you're not making the return that you hoped. But also it ties up your ability to pursue additional deals at the same time. And it can affect your debt service coverage at a higher rate. So hard money should accelerate your strategy and not trap your capital is the point. So some smart investors will calculate their total capital at risk and not just the monthly payment on the loan. So you got to factor that amount in your carrying costs into what your financial picture is. Now let's look at when money loans really do make sense. And hard money can work when the discount is deep on the buy side, or if the timeline is short and controlled, or if you're very confident about your exit pricing, and if your renovation scope is limited or clear, and when you can potentially get long term financing um, as a plan B. And in medallion funds, we can often structure situations that fit just that criteria, from bridge to DSCR transitions, or bank statement loan exits, or commercial takeouts, or even SBA refinance strategies. The key is aligning your short term leverage with your long term capital planning. So let's look at hard money versus structured financing. And traditional financing options may include loan products like a DSCR loan, or portfolio lenders, or bank statement programs. But there's also commercial bridge loans. Construction to perm loans are another option. Now, while these loans may require more documentation, what they do is they're often going to reduce your total interest expense, your refinance risk, but also your capital exposure. And in doing so, the pressure on your exit timing. And now, there, the difference isn't speed, it's sustainability. So that's the thought that you can focus on. Now, the final thought for the day is the cost of capital versus the cost of mistakes. And hard money isn't bad by any means. What it is it's expensive insurance for speed. But if the deal only works because the leverage is aggressive and the timelines are perfect, it's potentially fragile, is the larger point. Now, the most profitable investors in Houston and across South Texas, Central Texas, excuse me, will underwrite like lenders. They're going to stress test their timelines, but they're also going to pre plan and line up their exit. And what they're doing is aligning capital with strategy. And financing is not just about obtaining an approval, it's about structuring it the right way, the holistic way. Now, if you're evaluating a hard money loan and want a second opinion, we can model the numbers side by side with alternative structures to reach the same goal. Because protecting your margin is protecting your future. And that's a fun thought. My name is Bill Rapp. My company's name is Medallion Funds. I'd love to talk to you more. My website is billrapponline.com. Please visit there, figure out how to get a hold of me. Love to talk to you about your situation.